Hi everyone, welcome back. We're going to continue with taxes and personal financial planning. Earlier we talked about the difference between withholding and taxes. The reason why we have withholding is because the federal tax is a pay-as-you-go system. Pay-as-you-go meaning that in theory, you're supposed to pay income tax as you earn your income, not at the end of the year. If you do not pay your tax as you earn your income, and any substantial underpayment, that's called underpayment, and that is subject to penalty and interest. So how do we make sure that you are paying your taxes as you earn your income? One way is through withholding. So your withholding means that your employer deducts what they estimate your tax to be from your paycheck and send that money to the IRS directly every pay period. So this is estimation that's important. So how do your employer figure out how much tax to deduct? The amount that they held back, meaning the estimation, is based on information that you put on the W-4. The W-4 form is called the withholding certificate. When you start a new job, you will be given a lot of paperwork to fill out. One of them is the W-4. So the first step is to put in your filing status. Now you know what your filing status is, or you know where to go to find out your filing status. The second step on the certificate is whether or not you check if you have more than one job or if your spouse work and file jointly. And the third step is to list the number of dependents, and the last step is to list other income. So here's a sample W-4 form. So here's your filing status, and step 2 is a multiple job or spouse works. Most of the time you can leave this blank and leave this alone. And what is better is to simply put down extra withholding. So you can put in other income not from your job. So you want to withhold for other income you expect this year that you won't be withholding. So let's say you have a side job and you expect to make $40,000 or $20,000 from that side job. You just put that amount in here. And that will increase your withholding from this job so that you don't have to take money out from the other job. Dependents, so this is relatively straightforward. You just multiply the number of qualifying children under age 17 by $2,000 or other dependent. So if you have someone that dependent on you, so you can claim them as dependent, meaning that you pay for more than 50% of their living expenses. You need to complete a W-4 for every time you start a new job. You also want to submit a new W-4 if some of your status change. The most common change is either your filing status change because of marriage or divorce, or the number of dependents change, such as a new child either by birth or adoption. Also, you may want to submit a new form if you decide to take on a part-time job or a side gig and you need to add to your withholding. These are the steps if you have a job with an employer and you fill out a W-4 form. If you are self-employed and that's your primary form of income, you have to do a little bit more work. The rule of thumb is that you want to submit quarterly, meaning 4 times a year, estimated tax payment if this type of income represents more than 10% of your total income. You can complete an estimated tax return for individual. We'll go over how to fill out the 1040. This is the same form that you will use when you're filing your regular tax. The first payment is due on April 15th, and then every quarter. So the next one will be June 15, September 15, and January 15 of the next year. At the end of the next year, you still have to submit a regular tax return. So even you have submitted the ES, which is the estimated return, at the proper time, you have to submit the final or the regular return as well. So self-employment, even gig economy, gig job can increase your paperwork. Just pay attention to that. As we said, if your gig income is not very high, you can simply add the additional withholding to your regular job. How do you compute and file your income tax? First, note that the deadline for federal tax is always April 15. If there are holidays, that will be the first Monday after April 15. If April 15 happen to fall on a Sunday. Almost all the states follow the federal deadline. If your state is, but you want to double check what your state's actual deadline is. The form that we will go over in this class is Form 1040. This is the form for most individuals. The good news is there are lots of places for help. A lot of them are free. One program is called VITA, Volunteer Income Tax Assistance. Some state is actually a VITA site, so each year we train our VITA volunteer. You can become a VITA volunteer. You do not have to be an accounting student or an accountant. All students are welcome, and it's a great opportunity to learn about taxes and also give back to help others. Another option is the IRS Direct File Program or the IRS Free File Program. These are free help. You can also purchase tax software. You can also hire someone else and pay someone else to prepare your tax. For most of us, our tax is relatively simple. Either a VITA program will help us, or the IRS free file or a version of tax software will be sufficient. We already talked briefly about income. Your gross income includes all the categories that we had talked about. Your earned income, your investment income, passive income, short-term capital gain, long-term capital gain, even though they may be subject to a different tax rate, and other income, so prices and so forth. The great news is that you don't have to pay tax on all your income. Some income are exempt, and you are able to exclude some income. So what are they? Tax-exempt income is income that is not subject to tax. Some state bonds, they're called municipal bonds or munis. Interest on those bonds are tax-exempt, meaning that you do not have to pay federal tax on them at all. So this is all federal tax. We're not talking about state tax because each state has its own system. Tax-deferred income are income that will be taxed at a later date. So for example, contributions to your retirement account, whether it's 401a, 403b, IRA, those are retirement contributions. Those are called tax-deferred. So the income is, the contribution to those retirement account is excluded in this year's income, but they'll be taxed at a later date. Another exception or exclusion is interest on student loan. So if you pay any interest on student loan, you can use that as an exemption to reduce your gross income. So your adjusted gross income, this is AGI. You'll hear AGI over and over again. This is the number that a lot of loan company and banks look for when they are evaluating your income. Your AGI, your adjusted gross income, is your gross income minus exemptions and exclusion. Your adjusted gross income is still not what you pay tax on. So more good news. There are deductions. Standard deduction is the amount determined by the IRS, and it changes every year to account for inflation. This amount is based on your filing status, your age, and your disability, regardless of income. You can look up the most recent values on the IRS website. Here are the amount for 2025. Is $15,000 for single. And for married couple filing jointly, it is $30,000. And head of household is $22,500. Standard deductions are simple. You just look up the amount and you can use it. You also have the alternative to itemize your deduction. Itemizing your deduction requires more work, and you need to have receipts and to document your deduction. It is worthwhile if you have a lot of tax-deductible expenses. The most common ones are mortgage interest. This is limited to the first $75,000 of mortgage amount. So if you have, let's say you are single and you pay more than $15,000 in mortgage interest, then itemized deduction will be worthwhile for you. Some also pay state and local income tax and real estate tax, and those are capped currently at $10,000. Again, that amount can change over time, just like the most recent values. All the limits are subject to change. So if you pay a lot of income tax or property tax and mortgage interest, then itemized deduction may be worthwhile for you. You also can have charitable donation or medical expenses. If you spend more than 7.5% of your adjusted gross income, so AGI is adjusted gross income, then you can deduct the amount over that for medical expenses as deduction against your taxable income. Now we come to taxable income. Taxable income is your adjusted gross income, your AGI, minus your deduction, whether you use standard deduction or itemized deduction. So the taxable income, this is the amount that you pay tax on. Now we remember the federal tax system is a progressive tax system. The way that it is implemented is income levels are divided into different tax brackets. The level for these brackets changes each year to account for inflation. Higher income tax bracket will have a higher tax rate. The IRS publishes their tax schedule. There is a schedule for each filing status. If you use either the IRS free file or a tax software, all this is automatically looked up for you once you have determined your filing status. The tax rate that you pay tax on, you pay a different tax rate for income in different bracket. The marginal tax rate refers to the tax rate that applied to your last dollar or the next dollar of taxable income. Whereas the average tax rate is defined as the amount of tax that you pay divided by your taxable income. The two are not the same. Let's see how federal tax is computed through an example. Jordan is a 24-year-old and they share an apartment with a roommate. Last year, they earned $65,000. They received $2,000 as graduation gifts, and he paid $1,500 in interest on student loans. It sounds like Jordan is single, and his earned income is $65,000. They don't have a whole lot of other expenses of income. The only exemption is the $1,500 in student loan. So their filing status is single. Their earned income is $65,000 minus $1,500 student loan interest as exemption. Their adjusted gross income, AGI, is $63,500. And remember, when we look up the information on standard deduction for a single filer is $15,000. So $63,500 minus $15,000 is $48,500. That is Jordan's taxable income. Again, the $15,000 standard deduction, we look it up from the IRS. The number that we want to focus on now is the $48,500 of taxable income. Remember, Jordan is filing as single. Here are the tax brackets for 2025. Jordan is filing as single. So these are the tax rates that applies to them. These are the different tax brackets. What that means is any income between $0 and $11,925 will be taxed at 10%. And any income between $11,925 and $48,475 will be taxed at 12%. And then anything between these two is taxed at 22%. Remember that Jordan's taxable income is $48,500. Remember that Jordan's taxable income was $48,500. That means they are in the last dollar that they earn is in the 22% tax bracket. So if they make the next dollar, $48,501, will be inside this tax bracket. However, the first $11,925 is taxed at 10%, and the next group is going to tax at 12%. Let's take a look at how to compute their tax. So Jordan's total taxable income is $48,500. The first $11,925 is taxed at 10%. So 10% of that is $11,993. And the next amount between $11,925 and $48,475. So this amount is taxed at 12%. So pause the video and compute this amount and see if you get $43,86. And then the last amount, so the bracket ends at $48,475. Their income is $48,500. So that means they are $25. So the $25 that they earn is taxed at 22%. So that multiplied by 0.22. So that's $6. You add up all the different tax amount that is computed based on the three different tax brackets of 10%, 12%, and 22%. You get $55.85. This is the amount of tax that Jordan owes. Notice that Jordan's income is here, so the next dollar they earn will be taxed at 22%. And that makes their marginal tax rate 22%. The average tax rate is equal to the amount of tax they pay, which is $55.85, divided by their taxable income of $48,500, and that is 11.51%. There are more good news. Even though the tax that you computed is $55.85, that may or may not be the amount that Jordan owes. That's because there are something called tax credits. Tax credits are used to reduce the amount of tax that you actually have to pay. Usually, tax credits have income limit. They are designed to help low-income family. Again, it goes back to the fairness idea of tax. Like, how can we make the tax system more fair? They are intended for workers with no income. And some credits will give you a refund even if you don't owe any tax at all. The two most common examples are child tax credits and earned income tax credit. To learn more about earned income tax credit, go to the IRS website. Tax credit is different from deduction. Tax credit reduces the taxes that you owe, whereas the deduction reduces your taxable income. So tax credits will reduce the $55.85 that Jordan owes. So you subtract tax credit after you've computed your tax amount. Think about a marginal tax rate of 22%. A $1,000 tax credit will reduce your tax owed by the entire $1,000, whereas a $1,000 deduction will only reduce your tax by $220 because that's reducing your taxable income, not your tax. So the term deduction versus tax credit mean very different things in tax. The last is how do you file and pay your taxes now that you have computed your tax. Most people are required to file income tax by April 15th. Even if you are not able to file on time, make sure that you file an extension. Now, just because you file an extension, you still have to make estimated payment. So it's when you go to the IRS website to file the extension form, there is a box you can check and just go, it will direct you to make the estimated payment. That's because an extension does not delay your payment penalty. So make sure that you make your estimated payment by April 15, or else you'll still be subject to penalty. You can file later, but you have to make the payment now. Remember, it's pay as you go. Lastly, don't worry if you make a mistake. You can always file an amended return to correct your mistakes. How do you use tax in our financial planning? The first thing that you need to determine is how much money to withhold. You can use the IRS withholding calculator to estimate how much income tax you may be. If your income is relatively straightforward, meaning it's mostly from wages and from an employer, you don't have to worry about this. Your W-4 form that you fill out will usually withhold sufficient amount. The other thing that you take into account when you're doing financial planning is to make sure that you take advantage of all the tax savings that is available. College costs may qualify as a deduction. Student loan interest is an exemption. And then take advantage of tax-deferred investment, particularly retirement account, Roth IRA account. We'll talk about all those IRA, 401k, 403b. We'll talk about those in the retirement planning session in a later chapter. All these investments are excluded from current income, and later on you will have to pay income on both the investment and the return later on when you take it out. And then there are tax-exempt investments such as Roth IRA and education savings account. The difference between these two is that the contribution in this tax-exempt investment is not excluded, but the income on them are tax-exempt, meaning you don't pay tax at all. Tax-deferred means you pay tax later. Tax-exempt means you don't have to pay tax at all. Lastly, a quick word on tariff. Tariff is a tax, so we want to address that. Here is a very simple example. Let's say you run a small business and you buy an item from a supplier and that currently costs you $10. You charge an upcharge of $3 to pay for rent for your store, payroll, and profit, and you sell the item for $13 to the customer. So your cost is $10. Let's say suddenly the tariff is 100%. So that means you have to pay $10 on the tariff for a $10 item that you purchase from a supplier. There are three scenarios that can happen. In the first scenario, all tariffs are passed on to the consumer. So the supplier continues to charge you $10 for the item. You pay $10 to the government when you purchase the item from the supplier as tariff. You upcharge the item for $3 to pay for rent, payroll, and profit, and now the price to the consumer is $23. So the entire $10 get passed on to the consumer. Another scenario is that the supplier is going to eat the tariff, quote unquote, so they drop the price of the item to you from $10 to $5. And so when you pay the supplier $5 and when you receive the item, you pay $5 in tariff to the government, you continue to earn your profit and upcharge $3, and the price to the consumer is $13 unchanged. This is if the supplier borne the entire tariff. The most likely scenario is scenario 3, where the tariff is shared by everyone involved, the supplier, your business, and the consumer. So let's say the supplier say, I'm willing to drop the price, but I can't drop it to $5. I can only drop it to $8. So when you get the item, you pay $8 to the supplier, $8 as tariff to the government, and you also reduce your profit. You only upcharge $2 instead of $3. So your profit gets reduced. The consumer now pays $18 instead of $13. So any of this scenario is possible, but the most likely scenario is some kind of share burden by all three parties. This concludes Chapter 4 on tax and personal financial planning. I'll see you back here again soon.